What if you could move to your dream home without selling your home first? I know the conventional wisdom says you have to sell first and then buy, but I'm going to show you a strategy that lets you flip that script. Buy your new home first, then use the proceeds from selling your current home to dramatically lower your new mortgage payment. I'm Jonathan Wilson, and I actually used this strategy myself recently. For about $500 in paperwork fees, I was able to reduce my monthly payment by almost $2,500, faster and easier than a traditional refinance. And today I want to walk through exactly how this works, including a real life example with actual numbers, because if you have the income to qualify and some equity in your current home, this could be a game changer for your move and allow you to make offers without home sale contingencies. Here's how the strategy works in simple terms. First, you get pre-approved to qualify for both mortgage payments and have a resource for your down payment on the new home. The pre-approval process will verify that your income can support both mortgage payments temporarily, which is crucial for the strategy to work. For the down payment, you will need at least 5% down. If you don't have the funds saved, maybe you can use a HELOC on your current home, a 401k loan, or maybe a family member can even help with a gift. Then you move into your new home and put your current home on the market. When it sells and later on after you get settled into the new place, instead of just doing a traditional refinance, you use those proceeds to do what's called a recast of your new mortgage. A recast takes that lump sum from your home sale and applies it directly to your new mortgage principal. Your lender then recalculates your monthly payment based on the much lower balance, keeping the same interest rate and loan term. The result is you get to move on your timeline, not the market's timeline, and you end up with a much lower monthly payment. Now let's talk about who this strategy works for, because it does require some financial strength. You need sufficient income to qualify for both mortgages. Lenders will look at your debt to income ratio with both payments included. This is only feasible if those numbers work. You need at least 5% down for a conventional loan. Remember, this strategy only works with conventional loans. Government loans like FHA, VA, USDA, they cannot be recast. Then you need enough equity in your current home to make recasting worthwhile. Recast minimums are typically about $10,000, and the more funds you have, the better. Now, you need to be able to handle both mortgage payments for 6 to 7 months. If your current home sells quickly, you should be prepared to carry both payments for this time frame. Once your home sells, I recommend putting the proceeds into a CD or high interest bearing account like we did. This gives you the time to get acclimated with your new home and see if there's anything else that you want to do to it. Maybe wait and see if rates do come down also and a refinance makes sense instead. Because once those funds are applied to a recast, they're gone. This isn't a strategy for someone living to paycheck either, but if you have good income, solid equity, this could be a fantastic solution who wants to move into their new home and have a more competitive offer without a home sale contingency. Let me explain mortgage recasting in detail, because this is kind of where the real magic happens and why this can be so powerful. Like I mentioned, a mortgage recast is when you make a large lump sum payment towards your principal balance and your lender recalculates your monthly payment based on the new lower balance. Your interest rate stays exactly the same, your loan term stays exactly the same, but your monthly payment is going to drop. So let's do a real example. Let's say you buy a $700,000 home with $140,000 down. So you have a $560,000 mortgage at 7%. Your principal and interest monthly payment would be about $3,726. Now later, when your current home sells for $550,000, after paying off your existing mortgage and selling costs, you'll net, let's say, $375,000. You use that $375,000 to recast your new mortgage. Your new loan balance becomes $185,000 instead of $560,000. Your payment drops to about $1,230 a month. Okay, that's principal and interest. That's $2,500 less per month with the same 7% interest rate in the same 30-year term. The cost for this recast is typically $500 in processing fees. Now compare that to refinancing, which may cost thousands in closing costs, require a completely new loan approval process and appraisal. Like I said, I did this myself recently and it cost me about $500 total. The payment reduction was almost immediate. The process was super simple. I just had to get something notarized and send it in, and it was much faster than what I honestly expected. The timeline coordination is crucial to making this work smoothly. Here is how I recommend structuring it. Phase 1, get your financing lined up. Have your pre-approval ready before you start house hunting. Thorough conversations with your lender are important here to make sure you understand all the requirements and timing. Phase 2, find and purchase your new home with a pre-approval in place. You can make competitive offers without a home sale contingency. This is huge for competitive listings and markets when sellers prefer really clean offers. Phase 3 is move into your new home and then list your current home. After you've moved out of your old house, you can properly prepare your current home for sale. Phase 4, hold and evaluate your options. When your home sells, put those proceeds into a high interest bearing account or a CD. And I recommend holding onto the funds for maybe a year or so just to get acclimated with your new home and see if mortgage rates decrease. Because if rates do decrease significantly, you might apply those funds to a refinance instead of a recast and have a lower rate. If you decide to move forward with the recast, contact your mortgage servicer to initiate the process. Now, this can take maybe 30 to 60 days, a lot of times much sooner than that. And then phase 5, enjoy your lower payment. Once the recast is complete, your monthly payments drop for the remainder of your loan term. The key is being prepared for each phase and having contingency plans if your home takes longer to sell than expected. This strategy works best when you've outgrown your current home and need to move regardless of market conditions. Or you're in a competitive market where sellers prefer non-contingent offers and you have substantial equity to make the recast meaningful. Now, the risks to consider are carrying 2 mortgage payments temporarily and the possibility that your home takes longer to sell than expected. The key is being conservative here with your planning and having sufficient reserves. If the strategy sounds like it could work for your situation, the first step is to get a clear picture of your financial position and run the numbers properly. Now, I've created a moving calculator that can kind of help you analyze the numbers here. You can find that calculator in the description below. Remember, don't rush anything. You want to understand your options so you can make the best decision for your family's future. Thanks for watching, and I'll see you in the next video where we'll talk about a completely different approach, using your home equity to eliminate debt while moving to a better home. I'm Jonathan Wilson, and I believe everyone deserves to have a fantastic mortgage experience. Thanks for watching.